This conference will now be recorded.
We are beginning our second lecture on the accounting cycle, the starting point in learning accounting. In last class period, we looked at the first two steps. Step one, analyze a business transaction, and step two, make journal entries. Today, we'll be looking at steps 3 and 4, posting to the ledger accounts and preparing the trial balance. That is going to lead us to step 7, preparing the financial statement, which is our goal in the course to learn how to prepare an income statement, a statement of retained earnings, a balance sheet, and eventually a statement of cash flow. But we will simply be looking at the first 3 of those steps in this lecture. So I'm going to come out of the screen share for a second. And I'm going to go back into screen share and change what we'll be looking at. And so what we're looking at now is the example that we worked on last time where we had 10 journal entries. We analyzed each transaction and we made a journal entry debiting one account and crediting the other account. As we said that whenever there's a financial transaction between two business entities, we have to, in that transaction, receive something of value and give something of value. So in this first transaction, we invested $10,000 in the company. The company received $10,000 in cash. It gave out in value the $10,000 in common stock. That was now, so the shareholders now have the stock certificates for $10,000. So something was given in value and something was received in value. We gave common stock, we received cash. And we went through 10 transactions. And so today, what we want to do is to look at our next steps in the process, which involves determining after these transactions, how much do we have in each of these accounts listed? How much do we have in cash, common stock, sales, receivable? We need to know how much is in each one of those accounts. So that is the next thing that we're going to do.
This conference will now be recorded.
To determine how much is in each account, we will set up a T account for each one of the ledger accounts. So cash, accounts receivable, supplies, accounts payable, short-term notes payable, common stock, dividends, sales, rent expense. And you'll notice that the order of these accounts is the same as it is in that chart of accounts. So we're going to start off with the assets. Then we're going to go to the liabilities. Then we're going to go to stockholders' equity. Then the revenues and the expenses. So, and our goal is to determine after all of these 10 transactions, how much is in each account. And so what we're going to do is post to the ledger. And in posting to the ledger if an item is on the debit side in the journal, it's going to be on the debit side in the ledger. If it's on the credit side in the journal, it's going to be on the credit side in the ledger. So let's post this transaction, and we post and we're going to post all 10 of these transactions. So the first one is where we invested the $10,000 to start the company. And so we're going to go to the T account for cash, and we're going to put in $10,000. Then I'm going to put a parentheses 1 to indicate that this is coming from that first journal entry. It's on the debit side. Next, I need to go to common stock. I need to put a 10,000, but it's going to go on the credit side. And I'm also going to index it so I can make sure I have it done, that I've, if I need to go back, if I miss posting something, then I can check journal entry by journal entry to make sure I post it. At the end of the day, these postings have got the balance, and we're going to balance these accounts out later. So hopefully we see here that we had a journal entry, there was a debit to cash, we put it on the debit side in the ledger, there's a credit to common stock, we put that on the credit side in the ledger. And so, we'll be filling this out with more accounts. We're just working with a simple example. Our second transaction was a cash sale. We debited cash and credited sales. And so what we're going to do, we're going to go to the cash account. We're going to debit cash for $50,000. And we're going to index this as 2, so we know that we've now posted the debit side of journal entry 2. Then we got to go to sales. And we're going to put that 50,000 on the credit side for sales. And so this gives us the posting completion for transaction 2. Let's move on to transaction 3, which involved collecting cash on work that we'd done previously. So we did some work, now we're collecting the cash. Once again, we're debiting cash and we're crediting accounts receivable for $20,000. So we're going to go to the cash account again, and we're going to debit it for $20,000. And we're going to credit accounts receivable for $20,000. And we're going to continue this process. We received a short-term loan for $25,000. And so having received this loan, once again, we're going to debit cash for $25,000. And we're going to credit short-term note payable for $25,000. Okay, so we've now finished posting the first 4 transactions, which involve a debit to cash. We're now going to look at a series of transactions where cash was paid out, and so cash is credited. In transaction 5, we bought supplies for $1,000. And so we're going to go to our T account for supplies, and we're going to debit supplies for $1,000. And we now have our first credit to cash. We next go to transaction 6, where we bought something on credit and now we have to pay for it. And so we bought something on credit, and we'll see that later. So we debit account payable and credit cash. So we're going to go to transaction 6. We're going to go to the debit side of accounts payable. And we go back to cash and put in our credit for the payment on that accounts payables. Transaction 7, we paid rent expense for $3,000. We're going to go to rent expense. We're going to debit it for $3,000. And this is transaction 7. We're going to go back up to cash. We're going to credit cash for $7,000. So cash is always going to be an account where there's a lot of transactions. So I need 3,000 there, not 7. And accounts payable was 5,000. I'm just kind of okay. Let's move on to our next transaction. So we're up to transaction 8, where we're paying out the dividends. And dividends are payments to owners. They're the payments to the owners. So when you invest in a company and get the common stock, this is how you get your payment back. So let's go to the dividends account. And we're going to debit it for $2,000. And we're going to come back to cash and credit it for $2,000. So our first 4 transactions dealt with cash receipts. Cash was debited. Our next 4 dealt with cash payments. Cash was credited. The next 2 transactions do not involve cash. In the first one, we purchased supplies on account. This is just like buying something with a credit card. And so we bought $8,000 worth of supplies. So we're going to come to the supplies account and debit it for $8,000. And we're going to go to accounts payable and put in the $9,000 credit. Our final transaction was a sale on account where we did the work, we provided the service, and we had not been paid at that time. And so in this transaction, we debited account receivable $30,000 and credit sales. So we're going to come now to account receivable, and we're going to debit it for $30,000. And so this is going to be transaction 10. And the credit is the sales, so we're going to go down to the sales account. And we're going to credit the sales account for the $30,000. So we have now posted to the ledger the journal entries. If it was a debit in the journal entry, it was a debit in the T account. If it was a credit in the journal entry, it was a credit in the T account, with our goal of determining how much was in each account. So that was our goal. We wanted to determine how much cash do we have on hand. Cash coming in was 10, 50, 20, and 25,000. And so that was roughly 105,000. Cash paid out was 1, 5, 3, and 2. And so that's 11,000. And our balance in the cash account is going to be the difference between the debits and the credits. And we're going to put that balance on the side of the larger. So our balance in the cash account should be 94,000. So on each account, we add up the debits, we add up the credits, we take the difference, and we put that balance on the side of the larger. If the debits are large, it's going to be on the debit side. If the credits are larger, it's going to be on the credit side. And we know that for the assets, the balances typically need to be on the debit side. In accounts receivable, we only had 2 transactions, so we're going to come down and put this balance in of $10,000. Supplies, we had 2 debit transactions, and so we know that this balance, we just simply add these 2 together, and it's going to be 9,000. So we have now determined the balance in each asset account. First account, we had a group of debits and credits, got a balance. Accounts receivable, a balance. Supplies, a balance. And they were all debit balance, which we said assets should have a debit balance. Now, when we go to the liabilities, we want to end up with a credit balance. So accounts payable on the debit side was 6, on the credit side was 9. And so that, wait a minute, let's see. That payment was actually $8,000. And then transaction 6, sometime I was just looking at that number, was 5,000. And so the difference here on accounts payable is going to be 5 less 8, or $3,000. So our balance is going to be on the credit side, $3,000. For the short-term note, we only had one transaction, and so we know that the balance here is going to be the $25,000. As you can see, only a few, like cash, will have a lot of transactions typically. Common stock, we simply have the one transaction. And so the balance in the common stock is going to be 10,000 on the credit side. So remember, we said the normal balance on a liability is a credit. Normal balance in common stock is a credit. Dividends, we had one transaction, $2,000. And so our balance sales, we had two transactions, so we can add those up. And that's going to be 80,000. So the balance in sales and finally for rent expense, since we only had one transaction, the balance is going to be $3,000. Notice the revenue has its credit balance, expense has its debit balance, dividends has its debit balance. So we have now gone through, made 10 transactions, recorded them, analyzed and recorded them, and we've gone through and we've determined how much is in each account now after those transactions. That's what we've done. To make sure there are no errors, such as where I had the incorrect amounts here, we prepare what's called a trial balance.
This conference will now be recorded.
We now move into, okay, we need to make sure that there are no mistakes in the balancing of our journal entries and what we came up with as the balance in each account. So what we're going to do is to prepare a trial balance. The trial balance is always prepared in the order of the chart of accounts. It's always prepared in that order. Assets, liabilities, stockholders' equity, which includes dividends, revenue, and expenses. And so we always are going to prepare our trial balance in this order. And our goal is simply to see if we're in balance, if our debits equal our credits. So let's look at what we're going to do. We're just going to go account by account. Cash is 94,000. We're going to bring the 94,000 down for cash. On the debit side, since that's where the balance is. Looking at our other two assets, accounts receivable 10,000, supplies 9,000. So we put them in here on the same side as they are in the T account. We go to our liabilities. Since their balance is on the credit side, we're going to put them on the credit side. So we have 3,000 for accounts payable, 25,000 for notes payable. So accounts payable, 3,000. And then we have notes payable, 25,000. We pick up our stockholders' equity accounts. Common stock has a credit of 10,000. So we put the 10,000 here. Dividends has a debit of 2,000. So we need to put the dividends debit here. Sales has a credit of 80,000. So we put the 80,000 here. And rent expense has a debit of 3,000. So we put this debit here. We add up our debits, and if I've added correctly, 9410, 9, 2,000, and 3,000, that's going to be 118,000. We go to the credit side, 325, 10, and 8. That's going to be 118,000 also. And our goal at this point in the accounting cycle, journalize the entries, post to the ledger, prepare a trial balance, and make sure that we are in balance. So this is the starting point in accounting. So if you can do these three things, and this is what we focused on for the first part of the course, then you're well on your way to learning accounting. But if you can't do these three things, then it's hard to go through the other steps. We analyze the transactions, we journalized them, we posted to the ledger to see how much was in each account for our business. And as we look at our business, our account balance is cash is 94,000. That's good. Accounts receivable, supplies. We have some liabilities. We had good revenue numbers. So we're looking at what happened at each account. And so this is our focus at this point in the course. And we'll be testing at this point to ensure that you can do these first 4 steps. Thank you.